Welcome back to the show. You are watching um, me, your favorite host, Namdi, and today I'm going through this journey of learning technical analysis, so I can trade options and crypto and trade securities. I'm using um, multiple resources, videos, books, all around technical analysis to give me the background information that I need. Just like I said, I'm learning this stuff and I'm taking you along with the journey. If this is the kind of content that you came here for, then stick around. You might learn something. But if it's not, then you're also welcome to stick around. Or you can go find a different content. Um, but thank you all for joining this show. In this particular episode, I'm going to be reading, not just reading, but I'm going to analyze it and make so that it makes sense to me, and I'm hopefully it makes sense to you as well. In this episode, on this particular video, I'm going to talk about how to discover patterns, how to figure out continuation patterns, and we're also going to talk about going over reversal patterns and measured moves. The whole point of this video is to understand how to um, read chat patterns using technical analysis. But you're wondering, what is a pattern? A pattern is a type of indicator traditionally drawn by hand on a technical on a chart. Um, you can use your trend lines or any one of your drawing tools to develop a pattern on a chart. Um, Chat patterns they're very powerful indicators, and it's important to have some basic knowledge of how to use them, how to use it to interpret or predict price action. It's a good idea to have a good knowledge of how to read patterns. So chart patterns are indicators consisting of geometric shapes drawn on the chart. So you could it could be a rectangle or a triangle. As with most indicators, a price forecast is embedded in a pattern identification. Just if most patterns employ will use straight lines, such as triangle formations. Some will use semicircles and semi-ellipses. Semi-ellipses would be patterns like head and shoulders. Pattern lines generally follow either the highs or the lows. You usually want to organize pattern types according to whether they forecast a continuation or a reversal of the current price move, although you can apply many patterns, including triangles or rectangles. Um, Either way. So when you hear people talk about patterns, you're going to hear things like double bottom, dead cat bounce. Uh, some of these names, they do seem a little silly. I don't know who came up with them, but they just give you information on price action. To most aspects of technical analysis, a pattern is it tells a story. It's a work in progress. You may think you see a pattern developing only to have that price action change course and fail to complete the expected formation. So keep that in mind that just like with any tool in technical analysis, there's no guarantee. You may have to start over after you draw your chart. Don't be don't be don't get emotionally attached to any chart that you've created. You might have to draw your trend line, you draw your support and resistance, and you think you've seen a pattern, you think you've identified it, and it may change course on you. technical analysis is statistical. So we're just trying to increase our percentage of success. There's no guarantee. So in summary, pattern identification can be frustrating and time consuming. You're going to make a lot of mistakes, and then even valid patterns will fail, just like any indicator. The reason to tolerate the pattern recognition process is that when you get it right, you have a powerful forecasting tool that can deliver high returns. So it takes a little bit of imagination and patience to identify patterns on the technical analysis chart. Not everyone can see patterns right away. Pattern identification takes practice, lots and lots of practice, and a lot of drawing and redrawing of lines and shapes until you get the hang of it. I mentioned triangles earlier. Just a quick definition of triangle. The triangle is characterized by a series of lower highs along which you can draw one trend line, and a series of lower lows along which you can draw another trend line. The two lines eventually come together at an apex before the point is reached. The price must pierce one of the trend lines simply in the course of trading in its normal range. Because most of the bars are trending downward, you imagine the odds favor a break to the downside. All right, I'm gonna find a good example here to show. Let's see, just a second here. Let me share the live stream. Okay. Anyway, we'll move on because I don't think I can share my screen. I was trying to share a chart, price chart, and so we can all look at what a triangle formation looks like. But I don't think that's possible. So we're gonna move on with the content. I'm hoping y'all can hear me. Check, 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 check. All right. Moving right along. Just to go over the triangle formation again and what it tells us when you see one. It's characterized by a series of lower highs along which you can draw one trend line, and another series of higher lows along which you can draw another trend line. The two trend lines eventually meet at a point. Before that point is reached, the price must pierce one of the trend lines simply in the course of its trading its normal range. And also because most of the bars are trending downward, you would imagine the odds favor a break to the downside. But sometimes the breakout is to the upside. Just keep that in mind. Most patterns don't deliver a gift wrap buy sell signal until near the end of the formation. As the symmetrical triangle pattern develops, the forecast is only uh, that a breakout will occur, not in the direction of the breakout. Think about the price action as it's buyers and sellers, and we're trying to form patterns, geometrical shapes here that give us an idea of what price action is going to do. And if you're noticing a downward trend and you're able to draw a trend line on one end, and on another downward trend on that same chart meets the initial downward trend at an apex, we'll form the triangle. And sometimes at that point, price action can either break to the upside or downside. Just so you know, you usually see a burst of a higher volume when a pattern reaches completion. The observation will start to make sense when you notice that there's low volume and suddenly there's a burst of high volume that precedes the breakout, and it serves as a bonus warning or an additional signal that there's a significant price move in one direction or the other. And here's a bit of warning when reading the triangle price chart, identifying a triangle pattern, or not just a triangle pattern. Pattern identification in general doesn't require that each single price in a series line up perfectly. Not every price high hits an overhead resistance line. For example, it suffices that several will hit the line. So when you're drawing a trend line, not all the price action is going to hit that resistance, that trend line that you've drawn. Just you want to get in as many price hits on that line as possible. All triangles, symmetrical, ascending and descending, have a top and a bottom. They have a resistance line and a support line, just as do any flags, pennants, and any other pattern on the chart. People have different opinions whether the top and the bottom lines must enclose every part of every price bar, or if it's okay for the bar to break the line by a tiny amount as a triangle pattern is developing. But generally, when a pattern includes a form of support and resistance, you want to focus on what's between the lines. Ignoring a break of the trend line is always wrong. You'll notice a lot of usable patterns on commodity charts. Remember that a continuation pattern tells you that buying or selling pressure is going to pause. It's starting to slow down. If a big picture trend is well established, the pattern suggests it will accelerate after the pause. A continuation pattern, therefore, is a good place to add more to a position because you expect an additional move in the same direction. Continuation patterns tend to be fairly short term, sometimes only a few days, and are often neglected as a consequence. Continuation patterns serve as a reassurance that you've identified the trend correctly. They also often point you to the ideal level of at which to place a stop loss order, such as the ascending line in the ascending triangle. To draw ascending and descending triangles, you draw a line along the highs of a price series and another along the lows, just like you would do with symmetrical triangles. In the ascending triangle, the price isn't making new highs, and the topmost, which is the resistance line, is horizontal. You may worry that the failure to make new highs means that the upward trend is over, but the price is not making new lows either. You can often expect a breakout of the top line to the upside. When you draw a horizontal line, when you can draw a horizontal line along a series of highs, remember to look for a rising line along the lows of the same, at the same time frame. Remember, let me say that again. When you can draw a horizontal line along a series of highs, remember to look for a rising line along the lows of the same time. Not only does the ascending line of lows confirm the trend continuation, but it also provides you with a ready-made stop loss level at the ascending support line. The ascending triangle pattern delivers the expected rise about 2/3 of the time. If you wait for price action to close above the top trending line, above the top trend line or your resistance line, then the failure rate drops to a mere 2%. The expected rise, by the way, is equal to the height of the triangle pattern. A descending triangle is a mirror image of an ascending triangle. The important point is that in a descending triangle, the price is falling to make new lows. It's failing to make new lows in the prevailing downtrend. You wonder if the trend is failing, but if you can still draw a line along the series of lows or lower highs, it'll be a mistake to buy at this point. The probability is high that the downtrend is going to continue. So let's talk about dead cat bounce. You may have heard about it before. A dead cat bounce is a peculiar continuation pattern that looks like a reversal at the beginning with a sizable upward retracement of a down move, but then fades back to the same downward direction. A dead cat bounce occurs only in downward movements, and no equivalent named pattern exists for a parallel sequence of events in an upward trend. So just to go over that again, it's a continuation pattern that looks like a reversal at the beginning. It has a sizable upward retracement of a downward move, but then immediately fades back to the same downward direction. It starts off with a negative fundamental event that triggers a massive downward movement. The average size of that downward movement is about 25%, but the price can shoot down by 70% or more in only a few days. The bounce is an upward retracement that may make you think the drop is over, but the pattern includes a breakaway downside gap about 80% of the time. And sometimes the bounce upward fills that gap. A lot of times traders mistake thinking that if a gap is filled, even partially, the preceding move has ended. But in the case of a dead cat bounce, it's one of the patterns that completely disproves this idea. By the end of 6 months after the gap, only about 54% of price moves had fully closed the gap. So remember that a dead cat pattern It starts off with a negative news that pushes the price action on the downtrend, but then just as it starts to make that downtrend movement or that downward direction, there's a quick price reversal. The average size of the down move is 25%, but the price can shoot down by 70% or more in only a few days. The bounce is an upward retracement of that downward movement that will make you think that the drop is over. But then the pattern includes a breakaway downside gap about 80% of the time. And sometimes even that bounce upward feels part of the gap. But it just means that that pattern is not done. It's going to continue to the downside. The dead cat bounce only occurs in a downtrend market. So here's a few things to remember. The bounce upward averages 19% from the lowest low. The average decline from the top of the retracement bounce is 15% and lasts an average of 3 months. The pattern fails to deliver an additional decline only 10% of the time, making the success rate 90%. Moving right along, patterns come into their own when you use them to identify a trend reversal. No matter how a trend comes to an end, chances are that pattern exists to identify it. The reversal patterns will look something like a double bottom. A double bottom will look like a W. The double bottom is essentially a retest of a low, and it predicts a price breakout for the upside, but only under certain conditions. These are the factors that will validate a double bottom. A minimum of 10 days between the two lows, and sometimes as long as 2 to 3 months. So between 10 days and 3 months between the two lows. A variation between the two lows should not be more than 4%. Variation between the two lows should not be more than 4%. A center up move of at least 10% from the lower of the two bottoms. A center up move of at least 10% from the lower of the two bottoms. The price must rise above the confirmation line to confirm that the pattern is indeed a double bottom and the forecast of a continued rise is correct. The confirmation line is a horizontal line drawn from the highest high in the middle of the W. The point where the price rises above the line is called the confirmation point. Remember that reaching the confirmation line drawn horizontally from the confirmation point is the most important identification key of the double bottom. That's where you enter the trade. Also, keep in mind that when identifying a double bottom, that sometimes the price bars or the candle bars will break the lines you draw to form the double bottom pattern. Breaking some of the bars is allowed in a formation where the line is not a support or a resistance line. Note the pullback as well. A pullback is a retracement to the downside, right? After the price breaks the confirmation line. A pullback usually occurs about 70% of the time in confirmed double bottoms, making it hard to trust your pattern identification. Every twin bottom is a true double bottom. Only about 1/3 of all the patterns that look like a double bottom end up meeting the confirmation criterion. In short, the pattern fails about 2/3 of the time. The odds are not every pattern is perfect to detect. One or both of the two lows of the double bottom could be rounded rather than pointed. When the first bottom is pointed and the second is rounded, you have a pattern that's called an Adam and Eve double bottom. You can imagine the other combinations, including two pointy bottoms and two rounded bottoms, or the first one pointed and the second one rounded. The two lows of a double bottom are separated by several months or even a year, and you can easily miss the pattern altogether. Also, keep in mind that minor retracements and even other patterns within the W can obscure can obscure the pattern. Some analysts note that big patterns last months as easier to see easier to see or identify on a weekly chart. So let's talk about double tops. A double top is the mirror image of a double bottom. It looks like the letter M. In a double top, the price makes a high, pulls back on profit taking as usual, and or on a sell-off. And then the bullish traders try, but they fail to surpass the initial high. The failure to rally a second time through the first high means that the bulls were beaten and the bears are now in charge. A true double top is usually accompanied by failing volume as the second top is being formed. As with this double bottom, you need to see the price surpass the confirmation level. The confirmation level, again, is the lowest point in the center bar of the M. You're going to need to identify, you need that confirmation level to validate the pattern. When that condition is not met, twin tops fail to deliver. When the condition is met, the pattern delivers a downward move, which is it's less reliable than the double bottom, but it's still impressive. Just like with double bottoms, double tops will have price action pullbacks after confirmation, which will make you think that or will cause you to doubt the pattern. But pullback periods averages only 10 days before the downtrend resumes. Top in reversal patterns like the double top are usually more short-term than bottom in reversal patterns like double bottoms. Tops take less time to form than bottoms because traders are more fearful of taking losses after a big gain than they are trusting of early signs of a bottom. Top in reversals are often more volatile as well, although they occur with equal frequency. The statistics confirm market lore that bull markets are easier to trade than bear markets. Bull markets are more orderly and may suggest that greed is strong than fear. Bull markets tend to have wider and deeper participation as well, because there are more traders who can go long than there are traders who can go both long and short, at least in equities. In equities, not so much in securities or foreign exchange, the buy side gains are theoretically unlimited, while gains on the short side are capped. A stock cannot sell for less than zero. All right. We're going to move on to the ultimate triple top, head and shoulders. A triple top or bottom is somewhat rarer than the double version, but the meaning is the same. The price falls, it will fail. The price will fail to surpass the previous low or high, signaling a trend reversal. The head and shoulders is no different. The head and shoulders pattern is a triple top that's easier to see. One bump forms the left shoulder, a higher bump forms the head, and a third bump forms the right shoulder. The head and shoulders pattern is the most widely recognized of all the patterns, and it deserves popularity because when the price surpasses the pattern's confirmation line, it delivers the expected downward move a whopping 93% of the time. The confirmation line connects the low point of each shoulder and is named the neckline. The price breaking the neckline predicts a price decline, whether the neckline is sloping upward or downward. If it's sloping, it doesn't matter if the neckline is sloping upward or downward, it will deliver a price to the downside. It's seldom that you see the neckline perfectly horizontal. A downward sloping neckline tends to deliver the biggest price move. If you stop and think about it, a head and shoulders pattern is a logical development of crowd behavior. A head and shoulders usually forms after a long uptrend. The dip from the first shoulder represents the normal retracement after a new high. The head then represents the triumph of bullish sentiment and sets a new higher high. The dip after that new high represents their third attempt at a rally. The price target is the last highest high, which is the top of the head of the head. The failure of the second shoulder to surpass the head is the end of the rally. Buying demand diminishes and the selling pressure takes over, forcing price action to the downside. Just as with double tops and double bottoms, some traders refuse to accept the pattern and they cause a pullback to the confirmation line 45% of the time. Pullbacks average about 10 to 11 days before stock resumes its decline. This is your last chance to exit the trade. So pay attention to those confirmation lines and price action in relation to them. Now, the little voice in your head that's going to give you hope will get you smoked. Remember that every trend that is losing steam, volume falls after the head. Although about half of the time, the highest volume is at the left shoulder and about half the time of the head, volume is low at the second shoulder. Volume on the breakout day and the next few days after the breakout day tends to be very high. This is not surprising because by now, a great number of chart-oriented traders have identified pattern and the neckline. Some traders may see only the breakoff support without having seen the head and shoulders pattern, adding to the number of traders who now want to sell. The head and shoulders pattern is easy enough to see, but many head and shoulders patterns are more complex and contain other patterns within them. So finally, let's talk about measured move. The term measured move is used in a number of contexts in technical analysis. It can mean a forecast of an upcoming price move, a chart event, including completion of a pattern. Unfortunately, these forecasts are seldom correct, or rather they vary by too much from actual outcomes to serve as a reliable trading guide. Remember that one definition of measured move is the price change expected to result from a particular pattern. For example, in the ascending triangle, pay attention. If you're paying attention to the height of the pattern, Imagine the distance between the high and the low within that pattern is $5. After the price breaks out above the top of the triangle, you expect subsequent rise to be the same amount, $5. One useful observation is that the size of a move after a pattern is proportional to the size of the pattern. When a pattern takes a long time to form, like 3 months or more, and when it is very deep, about 30 to 50% of the annual high to low range, the bigger the eventual reaction to the pattern. You often get a sideways movement that results in a horizontal channel, which is also called a rectangle. You can project the height of the existing rectangle to gauge the extent of the breakout move. A measured move of this type has a certain amount of logic. Traders in a particular security may become accustomed to rises or falls of a certain amount before pausing or retracing. Another tip is that know that the downward move on confirmation of a head and shoulders is equal to the expected move only 63% of the time. It doesn't mean that you shouldn't pay attention to head and shoulders or use them when you see them. Just know that this reversal pattern is still valid, and if you own a security, you should exit at the pattern confirmation neckline, because so many of the other traders are going to identify the pattern and do exactly that, causing a self-fulfilling prophecy. Another type of measured move is when a price repeats the extent of a first move after a retracement. The retracement takes back 30% of the gain from the low to the high, or some other percentage. The point is that after the retracement, you often see price resume the trend at the same slope and to the same extent as in the first move. This type of measured move is finally, we'll talk about measuring from the gap. A third type of measured move is when you have a gap move. A gap is a price bar whose high or low is separated from the preceding bar by open space, meaning that no trades took place at those intervening prices. A gap is necessary, and it's important because it shows on the chart that something happened to alter perception of the security. What you want to do is you want to do the opposite in a downtrend. Let's see. Okay, that wraps it up. I hope that you got some knowledge out of this. I know I did. I'm gonna go over it again later on, just so I'll be sure that I grabbed enough of the knowledge with 38 minutes in this video. Thank you for watching this content. Subscribe to the channel, leave a comment in the comment section. Let me know how you feel in relation to technical analysis. Again, my name is Namdi, and it's been a pleasure bringing you this content. Thank you. We'll see you next time.